Are you ready to get rich in the 2024 recession? Now I know what you're thinking, a recession in 2024? Yes, you heard it right, folks. We're predicting a dip in the US economy by the middle of next year. The signs are all around us, just like those neon signs at a late-night diner, only these are not as inviting. High interest rates are one of those glaring signs. Picture this. You've got a bucket full of money, sounds great, right? But then, every month, a little chunk of that money is taken away because of interest. That's how high interest rates work, and they're not as fun as they sound. And then there's reduced consumer spending. Imagine going to a party, but no one's dancing, no one's mingling, everyone's just standing around, not really spending their energy. That's what an economy with reduced consumer spending looks like, a party with no action. When these two factors come together, it's like a domino effect. High interest rates mean less money to spend, and when people spend less, businesses make less money. This leads to job losses, which further reduces spending. It's a vicious cycle, like eating an extra slice of pizza when you're already full. It feels good at the moment, but you'll regret it later. Humor aside, these are serious issues. A recession isn't a simple dip in the economy. It's a significant slowdown that can take years to recover from. It's like getting stuck in a traffic jam when you're already late for an important meeting. It's frustrating, it's stressful, and it seems like it's never going to end. But don't worry. We're not here to spread doom and gloom. Just like a good weather forecast, we're here to give you the information you need to prepare. Because when it comes to the economy, forewarned is forearmed. So, what can we do about it? Stay tuned to find out. Before you consider jumping into stock market investments, there's an important first step: managing high-interest debt. Now, why is this so crucial? Well, let's paint a picture. Imagine you're carrying a credit card balance with an annual interest rate of, say, 20%. At the same time, you're considering investing in the stock market, where historically the average annual return is about 7 to 10%. You might think, hey, I can make some money on the side while paying off my debt. But here's the catch. The interest you're paying on your debt is significantly higher than what you could potentially earn through your investments. In other words, the cost of your debt is outpacing your investment gains. It's like trying to fill a bucket with a hole at the bottom. You're pouring in water, or in this case, money. But it's just draining out faster than you can replace it. And let's not forget about variable interest rates. These rates can fluctuate over time, and if they increase, the cost of your debt goes up too. So, you could end up paying more in interest than you initially planned. It's a bit like playing financial Russian roulette. And that's a game you don't want to play. That's why it's essential to tackle high-interest debt first. Pay it down. Or better yet, pay it off completely. Once you've done that, you've effectively plugged the hole in your bucket. Now, any money you pour in through your investments can accumulate and grow, rather than just disappearing down the debt drain. You might be eager to jump into investing, especially when there's talk of a recession and potential buying opportunities. But remember, the stock market isn't going anywhere. It'll still be there when you're ready. And you'll be in a much better position to take full advantage of it without the weight of high-interest debt holding you back. So, before you dive into the deep end of the investment pool, make sure you've got your debt under control. Prioritize paying off high-interest debt, and then with a clear financial slate, you can confidently embark on your investment journey. Remember, a debt-free investor is a stress-free investor. Now that you've tackled your debt, let's talk about building a rock-solid, long-term passive investment portfolio. Investing is not a sprint, it's a marathon. And the key to running a successful marathon is to pace yourself. This is where a long-term passive investment strategy shines. It's all about slow and steady growth, not quick and risky gains. Think of it as planting a tree. You don't expect it to bear fruit overnight, do you? Similarly, a passive investment portfolio needs time to grow. You plant the seeds, which are your investments, and then let them grow over time. Now, how to plant these seeds? Diversification is the answer. Imagine your investment portfolio is a garden. You wouldn't want to plant only one type of seed, would you? What if that particular plant is hit by a disease? Your entire garden would be wiped out. That's precisely why you need to diversify your investments. By spreading your investments across various sectors of the market, you're essentially betting on the overall growth of corporate America, rather than the success of a single company. You're minimizing your risks and maximizing your potential returns. Take the example of Warren Buffett, one of the most successful investors of our time. He didn't make his fortune by betting on one company or one sector. He diversified his investments, focusing on long-term growth rather than short-term gains, Or consider the case of John Bogle, the founder of Vanguard Group. He pioneered the concept of index funds, a perfect example of passive investing. Rather than trying to beat the market, he suggested owning the entire market. This strategy has proven to be incredibly successful over time. Of course, building a passive investment portfolio doesn't mean you set it and forget it. It requires regular monitoring and adjustments based on market conditions. But the effort is minimal compared to active investing. Remember, the goal here is not to become rich overnight. It's about building wealth over time, steadily and securely. So keep your eyes on the horizon, not on the immediate bumps in the road. As they say, don't put all your eggs in one basket, diversify your investments. You've diversified your investments, but how do you ensure they're safe? By scrutinizing a company's balance sheet. When we talk about scrutinizing a company's balance sheet, we're essentially playing detective. We're looking for clues that tell us if a company is financially stable or not. And the most crucial evidence, cash reserves and low debt. Let's start with cash reserves. Cash is king, as they say. It's the lifeblood of any business. It's what keeps the lights on and the gears turning. A company with significant cash reserves can weather economic storms and invest in future opportunities. It's like a ship with a well-stocked pantry, ready to survive a long voyage or unexpected storm at sea. On the other side of the coin, we have debt. Debt isn't necessarily a bad thing. It can fuel growth. However, too much debt can be like a giant iceberg lurking beneath the surface. It can sink a company if it's not managed properly. So a company with low debt is like a ship with a clear path ahead, free from hidden dangers. Now you might be wondering, how do we find this information? Well, it's all there in the balance sheet. The balance sheet is like a snapshot of a company's financial health at a given point in time. It tells you what the company owns, its assets, what it owes, its liabilities, and the difference between the two, its equity. So when you're looking at a balance sheet, pay close attention to the cash and cash equivalents line. This will give you an idea of the company's liquidity. Next, look at the long-term debt line. This will tell you how much debt the company is carrying. Ideally, you want to see a company with high cash reserves and low long-term debt. Keep in mind that balance sheet analysis is more art than science. It requires interpretation and judgment. But as you practice and gain experience, you'll get better at spotting the signs of a financially stable company. Remember, a company's financial stability is as good as its balance sheet. Your investments are diversified and safe, but how do you ensure they grow? By assessing a business's competitive advantage and controlling your emotions. Let's talk about the moat, a term coined by investing maestro Warren Buffett. It refers to the competitive advantage that a business has over its rivals. Think about a company that can charge higher prices because it has superior products or services. That's a moat. It's a barrier that protects a company from competitors, enabling it to grow revenues over time. Now let's shift gears and talk about emotions. Investing can feel like a roller coaster ride. Ups and downs are part of the journey. But remember, as Buffett advises, investing is a long-term game. Don't let short-term market fluctuations cloud your judgment. Emotionally resilient investors stick to their strategies, even in turbulent times. Investing is a marathon, not a sprint. Stay focused and patient. Want to dive deeper into the world of stock market investing? We've got something for you. Picture this, a 6-week program designed with beginners in mind, crafted to guide you through the labyrinth of the stock market. Now, this isn't your run-of-the-mill course. We're talking about an immersive experience that includes a 4-hour video course and interactive group calls. Imagine a community of like-minded individuals, all on the same journey to financial freedom, sharing insights, and learning together. This program is more than just education. It's about empowerment. It's your chance to take control of your financial future, to understand the market, and to make it work for you. So are you ready to take that step? If so, we've got the tools to help you get there. Just check out the provided links for enrollment. Don't forget, spots are limited. So, grab this opportunity and start your journey to financial freedom.